Hi, this is Mike Larson from Money and Markets TV. Last August, Treasury Secretary Timothy Geithner wrote an op-ed called "Welcome to the Recovery." Maybe he should have named it Mission Accomplished, because his starry-eyed optimism seems every bit as misguided as President Bush's a few years earlier. In fact, I think any attempt to put a positive spin on the recent wave of economic news would just be putting lipstick on a pig. So I'm just going to lay out the facts. Number one, the economy created just 54,000 jobs in May, while job growth in March and April was revised downward. And the unemployment rate ticked up to 9.1%. Meanwhile, private sector employment is even more anemic, according to automatic data processing. Its index showed the addition of just 38,000 jobs, down 78% from April and the worst reading since September. These numbers make it clear that the job market is losing steam and losing it fast. Number two, manufacturing activity is decelerating. The Institute for Supply Management's benchmark index plunged by nearly 7 points in May to its lowest level in 20 months. The ISM's service sector index also posted a much bigger drop than expected. And third, industrial production ground to a halt in April, confounding economists who were looking for a gain. And don't even get me started on the housing market. The S&P Case-Shiller index suffered its biggest year-over-year decline since November of 2009. That leaves home prices in 20 top metropolitan areas at their lowest level in 8 years. And of course, we know that April housing starts plunged almost 11%, building permits dropped 4%, and pending home sales tanked 12%, far worse than economists were expecting. How could the economy possibly be weakening again when we just officially emerged from recession 2 years ago? And why are we staring down the barrel of another serious slowdown when government officials like Ben Bernanke promised us that quantitative easing, borrowing, and spending would save the economy? It's simple. Bought and paid for recoveries are inherently unstable and self-defeating. If governments and central banks could truly vanquish the business cycle by just printing, borrowing, and spending all they wanted to, with no consequences, wouldn't every single one of them have done it before? The reality is, the economic and political fallout from borrowing and spending too much eventually becomes too much to bear, and I believe that's where we are now. The $14.3 trillion debt ceiling is putting shackles on Congress and the administration, and so are global creditors and ratings agencies, who are increasingly punishing nations that think they can run up huge deficits and debt burdens. Meanwhile, the Fed's QE programs have wildly inflated commodity prices and jacked up our cost of living. They're pumping the asset markets full of easy money and fueling speculation, but the real economy can no longer support these artificially inflated financial economy prices. After all, as we just learned, the Fed can't print jobs and it can't boost wages. The bottom line is we've hit a wall, and the only thing you can do at this point is to protect yourself. So if you haven't already taken some profits off the table on your long positions, please do so now. This is the time to pare down your risk levels, regardless of what you're hearing on CNBC. Second, dump any stocks exposed to the weakest parts of the economy. That includes sectors like banking, construction, and retail. Third, if you're looking to turn this economic crisis into a major profit opportunity, check out my Safe Money's Crisis Trader service. It's designed to help you navigate all the treacherous twists and turns in this market. I'm Mike Larson for Money and Markets TV. Thanks for watching.